So what's your number? Because every director I ask this question to gives me the same blank look. A pause, then I'm not sure. And here's why it matters. Because without that number, retirement planning can lack a clear destination. Not your turnover, not your company valuation, not what's sitting in the pension today, your number. How much annual income do you actually need in retirement to live the life that you want? And how much accessible capital may be needed to support it? So let me put this into perspective using the latest retirement living standards. For a couple, the current figure for a comfortable retirement is around £62,700 a year. Now, if you both qualify for the full new state pension, which is around £12,548 each per year, just over £25,000 combined. So in broad terms, the remaining income gap is around £37,600. But £62,700 minus the two full state pensions equals approximately a £37,000 gap. If you used a 4% withdrawal rate as a broad illustration, you'd need capital in the region of £940,000. This is not a target, it's not a recommendation. Simply a way of showing why what's your number matters. Now, the actual figure depends on tax, investment returns, inflation, spending, health, longevity, withdrawal strategy, and individual circumstances. This is not carelessness. Most directors are focused on running the business. Clients, staff, cash flow, profit, growth. Personal retirement planning often gets moved to later. And later has a habit of arriving sooner than expected. Directors sometimes tell me they'd like to be comfortable on a certain figure. But when we work it through, actual spending, travel plans, family commitments, housing costs, future care needs, gifting, and the lifestyle they genuinely want, the real number is often different from the first estimate. Now that matters because every other planning decision flows from it. So what you expect from the company, how pension contributions are structured, whether the business needs to be sold, whether you continue working in some capacity, how much investment risk may be appropriate. All those decisions depend on the destination. You may know your company numbers inside out, revenue, profits, margins, etc. But the income you take from the business today is not the same as the retirement income you'll need from your capital tomorrow. So once you know your number, the conversation becomes more useful. Target age, target income, existing pensions, company wealth, investment structure, tax position, potential sale proceeds, and of course family objectives. Because when those pieces are laid out in sequence, retirement stops being a vague idea but becomes something that can be properly assessed. Now, not guaranteed, but clearer. And clarity is often what directors are missing, because the directors who approach retirement with greater confidence are not necessarily the ones who earn the most. They're often the ones who understand the destination early enough to make informed decisions. So the question is simple. What's your number? And have you tested whether your current structure is likely to support it? If this kind of structured, director-focused planning is useful, you may want to subscribe to the channel. I'm Stephen Pitcher, Senior Partner with St James's Place, and I'll see you in the next video.